Hey everyone, my name is Peter and you're watching my daily trade log. I document one of my option trades every single day for your benefit so you can learn from it. And today is my trade number 220. But before I talk about my latest trade, I just wanted to have a quick word about the what's happening in the market. As we can see on the VIX graph, the VIX has been hovering around the 21, 22, 23 dollar mark for quite some time since the end of November, and I was wondering if we're going to see a spike. So that's actually a pretty high risk for options traders, as when the volatility goes up, then the option prices also go up. And if you have a bunch of positions, you sold a bunch of options, you're obviously shorting them. And let's say you sold something for $1, then even if the price doesn't move, but the volatility jumps up, then that option can easily be worth $1.50 or maybe even $2. So you will need to have significantly more capital allocated to that particular trade. So the $20 level for the VIX is actually relatively high. VIX is one of those indexes that has the tendency of reverting to the mean, which is around the $15 mark. So we're still, in a higher volatility period. But if we look at the volatility for the SPY, which is the S&P 500, then we can see that the volatility is actually quite low at 9.5. So it is a riskier environment for options trader, but nothing to worry about. There is always good trades to find. There's plenty of good trades out there, especially now that we're about to enter the latest earnings season. Over here, I have a diagram that explains why low risk environments are more riskier for options traders. So this line shows the standard distribution of price movement. So currently this is the price, and 68.2% of the time the price will remain between these two lines. This is called the one standard deviation. That's a very important metric for options traders. But what happens when there is a low volatility environment? That means the price movement, the price fluctuation is smaller. So over here in this dashed orange line, I indicated that in that case, the one standard deviation moves closer to the current price. So if you want to sell, let's say, your strangle at one standard deviation, in a higher volatility environment, you would be this far from the current price on both sides, the put and the call side. But when it's a low volatility environment, then you would be much closer. So that's obviously much riskier, because if the volatility goes up, then the one standard deviation moves out and your risk of being tested on the call or the put side is much higher. So that's why when there is a low volatility environment, then it's very important to make sure that we keep plenty of capital on the side just in case the volatility jumps up. So let's talk about my trade number 220. Today I sold a strangle against MRVL technology, and as we can see on the daily graph, the price has been coming down quite nicely from the highs of almost 90 all the way down to 37. So that's a huge drop. But since about October, it has been going between the ranges of 45 and roughly about 36. So if we take a look at the daily chart, then we can see that it has been going in this nice channel for quite some time. So I sold the 32.5 put option and the $45 call option expiring in February, and I collected $1.30 for this trade, and the capital requirement is very, very low. It's only $326 was required at the time of placing this trade, and therefore the annualized profit potential is quite huge. So this is a relatively low risk trade. I'm not expecting it to be quick. Strangles are normally not quick unless you have a high volatility situation. For example, over here, the volatility was much higher, and on this particular day, the volatility dropped. So if you saw the strangle over here, then the following day you would have been able to close your strangle even if the price didn't move. But at the moment, the volatility is only 23.8, so that's quite low. So I'm not expecting this trade to be quick. So that concludes my trade number 220. I hope you learned from it. If you like this video, you find it useful, please hit the like button and subscribe to my channel, and I'll see you on the next video. Thank you for watching.